welcome to this equity investment voyage. It gives me immense pleasure to again reconnect with you and express our view on the markets like we have been doing in the last 4 years. And when I stand over here at this point in time, it reminds me last year, okay, when we presented our view. I mean, that time the markets were totally different. I mean, we have seen a huge crash in the commodity prices globally. Oil had touched a new low of 27. Metal prices have also come down sharply. There was a period where we saw 1/3 of the developed market bonds were quoting at negative interest rates. And generally, there was a kind of a scenario, a gloom, doom kind of a scenario. A lot of strategists and global economists were talking about a recession. And that's the time we made a statement, if you remember, a quote by famous economist Paul Samuelson, who said that the market had predicted 9 of the last 5 recessions. Many people thought that we are making a mistake. But actually, that's what happened. People try to forecast. Nobody is able to get the market call right. And what happened last year, actually, if you look at, the market has been able to climb the wall of worry. In India, we saw big events, big negative events last year, right from Brexit. Rajan, governor, he exited. We had Brexit, okay, which was again a big event, which probably markets thought that it would be very negative for the global market as well as Indian markets. Then we had the historic demonetization when 70% of the currency in circulation was taken out. We had Trump winning the US elections, which was again a kind of a unknown factor. And if anybody had told you at this point in time that these events would have happened, I think the call on the markets would have been totally different. And what we had, the market has actually climbed the wall of worry and is given pretty decent returns of around 17%, and we are standing at a new high at this point in time. So I think it's important to understand that trying to predict the markets, I think, is something which is very, very, very difficult. And this has also been helped because, to some extent, by stimulus, which China came in and gave a fiscal stimulus that helped the global economy to reflate back. So at this point in time, with the markets at new high, in fact, today I was reading the papers, the world markets, if you look at the world market capitalization, total market capitalization has hit a record high of $50 trillion. So that's a new high what we have seen. So how does the market view look from here on? I think as we stand at this point in time, we see that the return on equities going forward are driven by the 8 Rs. These 8 Rs are reflation, Republicans, remonetization, the reform process, the rupee stability, rate cuts, and return of earnings. We'll take each one of these, how they are going to impact equities going forward. So what we see is this year has been a big reflation trade globally. From the lows of last year, we've seen the global trade has rebounded pretty sharply, both in nominal and in terms of real terms. Even the developed markets and the emerging market IIP has reflated back. And this is something which has surprised many compared to what last year the scene was. And to some extent, it is the liquidity, okay, which has driven that, and also the policy response, what we have seen from China and other markets. And a shift in stance from monetary stimulus to a fiscal stimulus has been one of the reasons. And while this is happening, we've seen the global growth outlook has improved. In fact, the first time we have seen increase in the global growth, primarily driven by increase in outlook in Japan, Europe, and partly from US. But while the global growth is improving and the headlines inflation is moving up in US and in Europe, the core inflation is really at a pretty benign level. It's more or less flat. It's not been impacted. And this is a kind of a Goldilocks scenario what we have at this point in time, where growth is improving, but inflation is benign. And this is good for risk assets. So the risk on, I think, if this situation continues, will going forward, and it will favor the riskier asset class. And at the same time, you look at the inflation has been pretty much under control. The second R which is driving is the Republicans. I mean, when Mr. President Trump came to power, we saw a lot of rhetoric, a lot of tweets coming in from the president, and talks about tax cuts, both the corporate tax and the individual tax cuts, a big fiscal stimulus coming in, trying to repatriate the money which is lying outside by giving tax incentives and the border tax. All these led to expectations of increased inflation and increasing growth. And we saw a big rally in the US dollar. And the bond yield spiked up almost 75 to 80 basis points. But thankfully, we have seen the Republicans, the party actually trying to guide Trumponomics, as they call it, and taking a more balanced view. And some of the reforms which Trump was going to do, especially in the healthcare side, we are seeing a moderation of that. Even yesterday, there was a bill which was passed to cut the the tax rate, corporate tax rate from 35% to 15%. We think it won't be to that extent. It will moderate it down quite a bit. And what it means is that because of that, the whole rally, what we saw in the US dollar, has kind of eased off. Bond yields have, which had spiked by around 80 basis points, have corrected by another 35 to 40 basis points. And that is good for emerging markets. I mean, last 2 years, we have seen a trade of emerging markets to developed market being played out. And this year, I think it's probably return of emerging markets with dollar being pretty benign. And also the fact that the emerging market valuations have also kind of corrected compared to the global markets. And emerging market growth is also looking better with commodities kind of stabilizing. So that would mean a fair share for India to really get a share of the flows from the emerging markets. The third R is remonetization. I mean, Mr. Dr. Subbarao talked about how demonetization impact and how the remonetization has happened. I think from the market perspective, I think remonetization has happened pretty fast. Almost 70% of the currency in circulation is back. And we've seen the services PMI, again, has come back into expansionary phase. Even the data coming in from the auto sector is starting to improve back. So I think the impact of demonetization has waned up pretty fast. And by the end of this quarter, we should have seen most of the sectors coming back on track. So while the growth rate for outlook for next year has come down a bit, but again, we are seeing a pretty decent growth at around 7.4% as per the RBI, which is a growth of around from 6.7% this year. It's a significant jump. And I think the outlook for growth looks pretty good. And as Dr. Subbarao also mentioned, that we are at a place where our growth should be fairly healthy. And if you look at that from a global context, I mean, India will be one of the fastest growing markets. I mean, it might not look too exciting to us growing at around 7.4%, but that's the kind of a fastest growth any large economy would be doing in the next couple of years. And as you know, money will chase wherever there is growth. Global liquidity will come in where there is growth. And I think India should see that money flowing in. The 4R which will drive the markets is the reforms. I mean, after the Modi government came to power, they'll be completing 3 years now. We have seen a slew of reforms, big reforms. I think we haven't seen that in a long, long time. I mean, we all know about the Jam Trinity, about Jan Dhan, Aadhaar, and mobile, okay, what it has done for financial inclusion. The direct benefit transfer, again, is a big reform where we are seeing subsidy being directed directly and trying to weed away all the inefficiencies in the system. I think this will have a permanent impact in terms of bringing down the overall subsidy burden for the government and improving the fiscal side. Again, focusing on doubling the farmer income. I think we will have Professor Gulati here talking about that, okay, what the government plans are in that direction. And again, demonetization has been, again, a big reform, while the benefit of that is yet to flow. But if you're able to see, as Professor Subbarao mentioned, increase in the overall tax to GDP ratio, I think that will be a big achievement for us to see. And GST, again, a landmark reform, which the government has taken, which was in the works for the last 20 years. And then various bills like the bankruptcy bill, the real estate regulatory bill. I think all these reforms, what we are seeing, we haven't seen the full impact of that. The full impact of that will be seen as the execution happens on those. So I think we don't require any more reforms. Most of it are in place. There are a couple of issues like the banking sector where we need to address the NPA issue, or the job creation, because that's going to be a big challenge for the government. How do they really improve that? These are probably 2 areas where we see the government needs to work on the reform side. So one of the big reforms we talked about was GST. I think finally the day has come. The government is expecting it to launch on 1st of July. I think we think it could probably happen in the 1st of October. But I think its work has been done and it's pretty much on its way. We won't have a 1 or 2 tier structure. It will be a 4-tiered structure, which will be there. But the biggest benefit of GST will be for the corporate India in terms of reducing the impact of cascading impact of taxes. And if the GST rate is around 18% or so, for most of the companies, effective the cost will be much lower. And that will be passed on the end consumer to bring down the prices and stimulate demand. So overall, I think with a short-term impact, say for 1 or 2 quarters, where as the transition happens, you will see a negative impact. I think there is no doubt that GST will help to improve growth. It will also bring down the logistic costs and efficiency for corporate India. But the bigger trend, what we see from GST is the move from unorganized to organized sector. I think demonetization to some extent demonstrated that we saw the organized sector was less impacted. But I think GST will further accentuate that. As the compliance increases, the smaller players will find it difficult. And the larger players will take larger market shares. And some of the sectors which will benefit because of this are consumer durables, consumer staples, building materials, and even auto ancillaries, where I think the bigger impact of GST will flow through. We have a GST expert, a senior partner from KPMG coming in and talking us about and looking at unraveling what the GST impact will be for the industry. I think housing for all, again, has been one of the big agendas for this government. I think if they're able to execute this, it's going to be a big game changer. I mean, we always had this rural, affordable housing policy, but post the elections, there was a small twist which was given to this to include all households with a household income of around 18 lakhs by way of interest subvention of 3% up to 12 lakh household income and 4% up to 18 lakhs. What it means is that the government is willing to pay out around 2.5 lakhs as an upfront subsidy for anybody buying a new house. This is only for first-time house buyers. And the government's vision is to have 2 crore urban houses and 3 crore rural houses by the next 5 years. I think they're able to kick this off effectively. I think it can be a big, not only employment generator, but stimulus to the whole economy. And government has also given some additional incentives to the developers in terms of tax benefits for the affordable housing, and also contribution to the EPFO. Persons can withdraw up to 80% for paying housing loans or EMIs. I think this whole, if it's executed properly, and I think currently the government allocation is pretty low, but I think they're serious about it. I think you could see a significant allocation to this. And the power of this is multifold. With 1 rupee spent, I think the government can have a 20 times impact in terms of new housing investments. So this, we think, can be a big game changer. And all the reforms, what we have seen, I think the proof of that in terms of India's overall rank in the global competitiveness, how it has improved, I think we have seen a significant jump in that. From a 71 rank, we have moved to 39 rank in the matter of 3 years. And that's a very commendable job. And that will have an impact in terms of how capital flows move into our country. And to some extent, the government has addressed some of the key issues which were impacting in terms of taxation. They have addressed the retrospective taxation, and those things have been put to rest. On corruption, which was a big issue, demonetization and the efforts which the government is doing will help to address that. Infrastructure, which was a bottleneck, I think the thrust to the infrastructure, both on roads and railways, will help to improve the logistics costs. So I think some of the issues the government has addressed has helped us to really move up in terms of global competitiveness. And that has finally got reflected in terms of the FDI flows. As Ajay mentioned earlier, we have seen record FDI flows in the last 2 years, almost touching $50 billion. And this is a combination of increase in FDI in a lot of sectors, but also as India's competitiveness increase, I think we should see this number going higher. And I mean, foreign direct investment is important for a country like us, where our saving rate is still pretty low. So to really to fund our growth, I think this is going to come in pretty handy. The 5th R, okay, which is responsible for economic increase, is rupee stability. In fact, in the last 2 years, while rupee has moved in a narrow band, it is one of the best performing currencies, not only among emerging markets, but also against the developed markets. But I think the volatile rupee has been the least, and that's more important. A stronger rupee is not necessarily good, but a stable rupee is good for everyone, for investors who are investing into the country, but also exporters and importers. It reduces overall your cost of hedging. So I think this has been a combination of price and external stability, what we have seen. I mean, inflation has kind of come down and is pretty much anchored around 4.5, 4, 5% or so. And both RBI and the government targeting that, I think that's a good thing. WA also has rebounded, but it's still pretty benign. And current account deficit is also pretty much under control. This is a kind of a good macro situation where you would see stability on the rupee and help foreign investors to come in a big way. The sixth R is the rural India focus, okay, with the government in terms of government focus is to increase farm income, double that in the next 5 years. We have Professor Gulati coming in and talking in detail over here. But I think government is taking incremental steps in terms of trying to increase the MSP prices gradually without taking in a big step. More importantly, the insurance cover which has been given, that has almost quadrupled in the last 3 years. And with good monsoons coming in this year, we have seen the output, the Kharif and the Rabi output has been at its peak. So if the rural economy really gets momentum, I mean, it has been a drag on the economy for the last 2 years because of the poor monsoons. And this year, I mean, expectations are the monsoon should again be pretty normal. Okay, we should see a big boost to consumption, which is a mainstay of our economy. The seventh R is the rate transmission, I think, which was something elusive. We have seen 170 basis point rate cut by the RBI governor, but rate cuts, transmission not happening. But after the demonetization, we have seen the SBI cutting the MCLR rate significantly, and almost all of the rate cuts have been now transmitted. So there has been almost 200 basis point kind of a reduction in the borrowing costs for the corporate India. And bulk of the benefit will come in this next fiscal year. For every 1% decrease in interest rates, the Sensex earnings can go up by around 3% or so. And finally, it's the return of earnings, because that's the most important for equities to do well. I mean, in the last 3 years, we have seen the equities returns, I mean, the corporate earnings have been more or less flat. This has been the longest streak what I've seen where earnings have remained flat. And we think that it's time for the earnings to return back in FY18. It should have happened in FY17 itself, but because of demonetization in the last couple of quarters, we have seen a setback to that. We think the earnings are set to reflate back again next year. Again, the factors for that are recovery in the global growth. The focus of the government on infrastructure, housing, and rural will help the domestic economy to come back. The rural economy come back because of the good monsoon, the rate cuts. All these factors will help the earnings growth to bounce back in a big way. And normally when we see that, when there have been 2-3 periods of strong growth, in the ensuing years, the earnings tend to surprise on the positive side. Up till now, earnings have disappointed, and analysts have gone wrong. I think I won't be surprised if things reverse going forward in the next few years. And where is this growth going to come in from next year? I mean, some of the sectors where we see will have very strong growth is autos. I mean, this is nifty earnings growth, primarily because of volume pickup, both in 4-wheelers and 2-wheelers. Engineering infra, okay, we have seen some pickup again there, especially in power T&D and the road sector. Media, metals, metal prices have rebounded pretty much, but a lot of Indian companies are seeing a deleveraging which will help them to increase their earnings. And financials. This is not only the private sector banks, but this year also will some the corporate banks, because the low base of last year should see earnings come back. Even pharma and cement will show pretty decent growth. So overall, if you look at if earnings growth is going to return back, and if you look at from a longer term perspective, last 15 years, earnings growth has tracked broadly the nominal GDP growth. And even if we assume nominal GDP growth to be around 11% going forward, I think your earnings growth in the next few years will slightly be higher, because last 3 years it's gone well below the trend line growth rate. So we expect around, on a conservative basis, around 15% earnings growth in the next 3 years. And considering the fact that the market valuation is currently slightly on the higher side than the long-term average, and if you assume some kind of multiples kind of derate from these levels, I think markets can still give around 13 to 14% returns going forward over the next 3 years. I mean, it might not excite many of us, but that's a very good return to look forward in this current circumstances. And the reason for that, I would say, is if you look at the long term, the real returns for Nifty, the average is around 6.5%, which is the risk premium what equity investors demand from the market. And with inflation likely to be around 4%, a 13% return is a 10% premium over the inflation, which is significantly higher than the risk premium what investors are looking at. So I think that's the kind of return, I think, if you are expectations in the markets are pretty realistic. I think the market should not disappoint investors over the medium term. And the good thing is that the money which is coming in the market, I think the color of that is changing. I remember, I mean, if you look at historically, whenever FIs had pulled out money in excess of $1 billion in a particular quarter, or $3 billion, the markets have corrected by around 5 to 15%. This time around, in the last quarter, when we saw, that was in December quarter, where we saw around $5 billion FI outflows, the market corrected by just 5%. And that's the power of the retail money which has come into the market, thanks to all of you who have been able to channelize that. And this money is pretty sticky money and longer-term money, and which should be able to support the market and reduce the volatility much lower than what was seen in the past. So while talking about the market, I think we presented the outlook. Why is it Birla Sun Life should be your partner really to participate in this wealth creation? So we talked about the first presentation which I made, we talked about the 3 Ps, which is processes, people, and performance. And then we talked about the clarity, commitment, and and wealth creation. So those are the pillars for our investment philosophy. Our aim is to really give consistent performance to our investors and help the wealth creation journey. And in that process, our equity investment team is something which has been the people have been the most important. We have a pretty large team in the industry, and we are proud to have that. And it's been a very stable team for the last 5 to 10 years, and that's very important in investment business. We have our senior fund managers who've got experience ranging from around 20 to 25 years, and we have been able to align some of the funds in terms of their styles, and that's helped them to really do much better. And analysts have got rich experience. Again, some of them have worked in the industry, and you will see some of them in the panel going forward. And with the rich experience of around 300 years managing your funds, I think your money is in safe hands. And some of the major calls, we talked about clarity, right? Clarity comes in from your processes and in terms of people. Some of the big calls which we have taken last year, one was you overweight on private banks and NBFCs. I mean, private banks has been our call for quite some time now, but NBFCs has been a clear outperformer, and we've been able to spot some of these very early, both in the mortgage finance and in the consumer finance and in the small ticket financing, in the gold financing side, and that has contributed immensely for us. You will hear Dhaval Gala, our analyst, in the panel, okay, talking to us in terms of how we are able to do this. The other big call we took was on metals. Again, we were able to catch that trade pretty well in the metals from the bottom. Again, Vineet Malu, our analyst, will be able to throw some more light on this. Overweight on oil and gas sector. This is a sector where we have been consistently been underweight for quite some time. It was only the last year when we increased, especially in the oil PSUs, when we saw there were structural reforms happening in the oil marketing companies, and with a view on the refining margins. Again, Milind Bafna, analyst, okay, you will hear him again in the panel discussion in terms of how we took this call. And broadly, we have been overweight and a big call on the consumer discretionary space. I think India, you will see per capita spends increasing, and with formalization of the economy, I think consumer discretionary space includes consumer durables, autos will continue to do well. Our call on pharma sector probably didn't do well because of what happened in US and also the policies, Trump policies. But we think this is a sector which is kind of waiting to really bounce back from these levels. Our big underweights were in IT and telecom, I think, which has again worked out well. And if you look at our journey from 9K, I mean, Nifty of 9,000 to now, 2 years, I mean, it's not gone anywhere. And the returns which some of our diversified funds have generated, the return has varied from around 11% to around 22%. I mean, that's the kind of an alpha which our diversified funds have been able to generate, which is a very good return to expect. And while we talk about this, I mean, there was some misalignment in the slides over here, but I think we have the bouquet of all the funds, okay, which could happen. I mean, we've got all the products from a low risk and equity side to the high risk, starting from the arbitrage fund, which we launched around 3 years back. We got a specialist to manage this fund. We also have the balance category, where we have recently introduced, not recently, we had a fund, but started propagating is the balance advantage fund, which is again a relatively new concept for us, which again, has been doing well. We have seen a lot of inflows coming in this category. Moving on to the large cap category, where we have Frontline Equity Fund and Top 100, Frontline being the largest fund in that category which has reached. Again, in the diversified category, we've got two funds, BSL Equity and the Birla Advantage Fund, which again have a very clear positioning. And of course, the tax relief 96 fund in the tax planning category. And then moving on to the mid-cap and the small and mid-cap again has been a focus for us, which we've again tried to retweak the product, get the focus back, try to have a more concentrated portfolio, and that's done wonders to that fund. And then you have the thematic funds like the MNC fund, which has been a stellar performer, long-term track record, the banking and financial services fund. So we have all the products, okay, which you would require for your investors. And our job is to really manage each and every product as per the style and not deviate from the objective. And we have done that pretty well. So if you look at long-term track record of our funds, last 10 years, I mean, they have generated alpha ranging from around 3% to around 6%. So even if you look at the 4% average alpha, which some of the funds have generated, I mean, that's a pretty good alpha. I mean, what 4% means over a 15-year period is that it will mean doubling your returns compared to what the market would have given. I mean, that's what it does. And a lot of our funds are now gained a lot of size and traction in the last 1 year. We have many funds now, almost 10 funds, which are now more than 1,000 crores in terms of assets under management. So the third C, which we talk about, consistency. I think the proof is there in eating the pudding. So in terms of beating the benchmark, we have almost 100% of our funds beating the benchmark across various time frames, 1 year, 3 year, or 10-year time frames. But more importantly, it's how we do against our peers. And as I said, our focus is to maintain consistency. We target to keep our fund always in the top 2 quartiles. And we have almost 93% of our funds in the top 2 quartiles, which is, again, something which we aspire to do and maintain that consistency going forward. Even CRISIL, which is an independent agency, as per their ranking, 76% of our equity AUM is in CPR1 and CPR2. CPR1 means top decile, and CPR2 means top quartile. So while we talked about the market outlook and in terms of our funds, I think one thing which I would like to, again, remind investors is that, I mean, all past corrections look like mixed opportunities when you look back. Only every time we see a correction, this time it looks like real. And that's been amply proven. Again, this is something which we have talked about earlier, but again, I want to re-emphasize that in the journey in the market in the last 15 or 20 years, we've seen immense amount of corrections. There are big, large dispersions where the markets have corrected. And at this point, we are starting at market at a new high and returns at around 17%. I think journey is still a long way to go from here. And I would say that before I end this, just remain disciplined. And I'm reminded of the quote by the famous investor, Howard Marks, who says that it's not the things that you buy and sell every day that makes you money. Okay, it is the things that you hold makes the money. And that's the discipline if you follow in investing. And I think I'm sure your journey in investing would be pretty smooth and rewarding. Thank you.